I wanted to hammer the misconception that VOO and or SPY is a great base for a portfolio. Yeah, you can say it's well balanced, but I can also add other ETFs in there and be able to rebalance the sectors out better. In my opinion, VGT is the best base, right? Because what moves SPY is the top 10 holdings for the most part, right? Which are the major holdings in VGT, which is basically VGT to an extent. Um, so you have about 300 companies that really don't do anything at all that are in the S&P and just run flat and they kind of lag. And the gains over the last 20 years and 10 years have been disgusting on SPY. Yeah, VOO is better because the expense ratio 0.03. Oh, wow, right? But it doubled. We're coming up on with the dividend tripled in 20 years. That's pretty pathetic. When Nvidia's went up like what? 55? You could have 55 extra money. Oh, we didn't have a crystal ball. Yeah, you did. You knew Nvidia was the best chip maker. But you didn't have a crystal ball. Well, yeah, Apple was the best, one of the best companies to invest in. Just their AirPods are bringing in more money than Netflix does, and that's just a small portion of their business. You didn't need a crystal ball. It was obvious, and it was obvious in '08. It was obvious in 2010, 2015, 2020. Apple was a banger. I'm not saying cherry pick stocks. Cherry picking stocks is dangerous for a portfolio when you have a lot of money in there because that something really bad could happen to that company. In my opinion, for the average Joe, ETFs are the way to go. But you can make the argument VGT, Vanguard Information Technology, or XLK, another great one. I like XLK a little bit better, but for the sake of this video, we're doing VGT versus SPY. You can make the argument that it's volatile. Great, so I have better entries, right? I have better entries due to the fact that it's volatile. We have a cup and handle right here. Everyone's expecting the market to go down. Technical analysis says we are going to explode to all-time highs. Explode. But let's go ahead and we're going to compare it. I wrote a blog recently on Z-Trade's website. We have a blog section in the very top discussing the difference between VGT and SPY. And I'm seeing a lot of young people, they put their portfolios, they're going full portfolio in SCHD with a 3% dividend. They're buying MMM that's dropped like 60%, 50% for a 6% dividend. AT&T, Verizon. What is wrong? It just blows my mind that people don't have. You don't need to be an expert. It's basic math. It's logic, right? I could put my money in JEPI that doesn't go down and get 10 to 12% a year and smoke most portfolios. And I don't have to deal with the. If you want to make the volatility argument, well, why not go into JEPI versus SPY? It's beating this, right? Maybe not this year. Maybe not if you bought the dip. That's a different story, which we're going to go into my investing strategy in another video where I only buy the crash. You can't time the market? Yeah, you can. To an extent, you can. You can see whenever it's dropped 10 to 20% and you can buy there. That's timing the market, right? Does that mean I'm going to get out? No, that's a different story. Getting out, yes. You can time entry. Timing exit's very hard. And I don't think someone should do that that's building a portfolio. But anyways, let's take a look at this. Average return from 2003 to 2023, 16% on VGT, SPY 9. So you're almost getting double. 5-year annualized return, 22 versus 14. 22 on VGT, 14% on SPY. 10-year, 18 versus 12, right? And the maximum down, get this, was actually less than SPY. So that stomps the volatility claim. Why? Because it's good companies. It's companies that are not atrocious, like a lot of them that are in SPY that lag it down and hold it back, which is why your gains are awful. Well, let's take a look at it. I like to use bar chart. You can type in bar chart compare on Google, and you can pump in the data. Now, this is not with dividend reinvest on. The data isn't going to be much different, okay? So since 2004 to now, you're up 829%, and it has a cup and handle on it on VGT. So does SPY on VGT versus 297. So I 3x my money. it's not hard to grow your money double if you're buying the crash on something like Apple or Nvidia. Very simple, right? What's a way that I can have exposure to that? VGT. I can grab the best companies that run the hardest, that have the brightest future, um, with massive amounts of cash. What is it? $250 billion Apple has in treasuries. They're not going anywhere. They have more money in the country of Egypt. Um, Fact check me on all this. So, I mean, why would I add SPY in here? Especially if you're young. If you're under 40, why would you be adding, you're under 40, under 45? Why would you be adding snail slow SPY? I know your financial advisors are telling you to do that, but that doesn't mean I'm right. This isn't financial advice. This is what I'm doing. VGT is the one. Now, if I wanted to add some of the sectors that are in here, I can independently do that when those sectors dip. If I wanted to add some mid cap, right? If I wanted to add, VBK, which is Vanguard small cap growth, a lot of the stocks in there are mid cap. They're teetering on mid cap and are pretty much mid cap. I could add a mid cap growth fund on the crash, right? During a crash or a dump on the market, right? Which you've had tons. 2016. Let's say you weren't around for 2018. 2016, 2018. Who remembers the fall of 2018? What else do we have? 2020, 2022. 2022 is the easiest crash. The Fed told you they were going to raise interest rates. Excuse me. So what does that mean? That means value is going to hold or go up because value will go up because people will rotate into it. But growth is going to go down, especially new companies like ARK. That means they're just getting obliterated. But the Fed told you that the market was going to crash in 2022, basically. You didn't need a crystal ball. They told you that. The people that say the whole crystal ball thing, they just don't understand how the market works and they don't know how to identify opportunities. Now, you can use that argument about timing and exit. Yes, I don't have a crystal ball. Entry, piece of cake, right? Because we can use TA. But technical analysis says, again, guys, this thing's going to explode. It's November and December. These are bullish months. So in my opinion, and I'll do a video on a well-balanced portfolio, you don't want all growth, right? I don't want all growth, I should say. I take that back. I don't want all growth. I don't want just appreciation, right? Because then it can just come back down and I have the same amount of shares. I need realized gains and unrealized gains. I need something with good dividends, right? And or yield, which is like why I like funds better, right? Hint JEPI, as well as growth. And from there, I can add other sectors that have to do with energy, commodities, right? I can add, it's very easy to build a portfolio, and financial advisors are horrible at it. They get uncomfortable. The ones that I personally know, they like kind of sink back because they don't want to talk about it. Not even that I get argumentative, because they don't know. They don't understand what's coming. They have analysts that tell them all they are is salesmen, and they charge you for something that you could enter in 5 seconds on Robinhood with a beautiful user interface for someone that just wants to invest. And I could add, again, JPI, VGT. If I wanted to add an energy fund, it's a little bit too late in my opinion. I want to see what's happening on elections. I don't need energy. TLT, chance of a lifetime right over here. We're at 2002 lows we just bounced off of, and I had been calling it on the bear flag break off support, which we have bullish RSI divergence. Piece of cake. Do I need a crystal ball? No. Can I time the entry? Yeah, I can, guys. Those of you that say that, again, you don't know what you're doing and you don't know what you're talking about. And guess what? I was right. I did time the entry nearly perfectly. And what happened? It went up and I'm green. Can you believe that? So to wrap this video up, VGT has hammered SPY, hammered it. And I believe SPY has a lot of lagging, crappy companies, and it's just for people that don't know what they're doing. They can add that. Again, I don't mean to bash you too hard. It is a great base. VOO over SPY due to the expense ratio that we talked about up here. Where is it? Yeah. Well, that's VGT. VOO is still 0.03%. It's Vanguard as well versus SPY 0.09. So yeah, I'm going to do some more videos here regarding building portfolios and how I do it. And it isn't financial advice. It's just simply how I do things. If you guys like this content, like and follow for more. I'm going to be producing content pretty much on a daily basis.